In today's video, I want to give you an update on the housing market as we head into 2026. The big question is, will there be a housing market crash next year that finally makes homes affordable for the majority of Americans? Let's break it down in this report. Stop scrolling for a moment, because what just happened in the silver market was not normal, not healthy, and not something you can afford to ignore if you're exposed to metals, miners, or leveraged trades in any form. Silver didn't simply pull back, it didn't gently cool off, and it didn't respect anyone's expectations. It surged, it screamed, and then it snapped back with violent force, wiping out nearly 16% from the intraday peak in a matter of hours. And moves like that don't happen in calm, rational markets. They happen when leverage gets excessive, when positioning becomes crowded, and when the people running the system decide to change the rules while everyone is already all in. 2 days ago, silver printed levels that convinced a lot of traders the breakout was finally confirmed, that the next leg higher was inevitable, that triple digits were no longer a question of if but when, and then the floor disappeared. This wasn't just selling, this was forced selling. Margin requirements were raised back to back, and that's not a coincidence, that's a signal. When exchanges hike margin aggressively, they're telling you something very specific. Too many participants are leaning in the same direction, and risk has become unacceptable to the system. At that point, your thesis no longer matters, your conviction doesn't matter, your long-term narrative doesn't matter. What matters is collateral. If you were long silver, using leverage and margins jumped. You didn't choose to exit. You were pushed out. And when forced liquidation begins, it doesn't stay contained. It cascades across portfolios, across asset classes, across correlated trades, and that's why the sell-off felt broad, sharp, and emotionally disorienting. Miners sold off, other metals sold off, and even positions that had nothing to do with silver directly felt the pressure. Because risk managers don't debate philosophy, they flatten exposure. Now here's where most people get it wrong. They focus on the size of the move instead of the structure of the move. Yes, silver spiked. Yes, silver reversed. But the critical detail is how fast it happened. Speed is what creates forced behavior in markets. Speed is what turns normal volatility into liquidation events. When silver rallies double digits in a single session and then gives most of it back almost immediately, that's not the end of a story. That's the market telling you liquidity is thin, emotion is high, and weak hands are being systematically flushed. This is exactly how late-stage momentum environments behave. They don't top politely. They exhaust themselves through violence, through whipsaws, through moves that feel personal because they are mechanical. And if you think this dynamic is isolated to silver, you're already behind. Platinum executed the same pattern, a sharp vertical advance followed by a rapid reversal, and that tells you this isn't a single market issue, it's a positioning issue. This is what crowding looks like. This is what happens when everyone tries to run through the same door at the same time. Now, let's slow this down and get precise, because precision is how you survive environments like this. The first real takeaway is simple but uncomfortable. The move itself isn't the headline, the speed of the reversal is. Speed forces liquidation, and liquidation creates collateral damage. The second takeaway is even more dangerous for most traders. Stabilization is not safety. Just because silver stopped falling for a few hours or started chopping sideways does not mean the storm has passed. Sideways action after a shock is often the market reloading pressure. Most participants look at a pause chart and convince themselves the worst is over because price isn't actively collapsing, but the most important candle has already printed. That large red candle that swallowed the prior green session is what technicians call a bearish engulfing pattern, but labels don't matter nearly as much as context. In late cycle environments, those candles act as warning flares. They don't predict the future, but they mark zones of heightened sensitivity where the market is deciding who stays and who gets pushed out. These signals tend to have short shelf lives, 1 to 3 sessions where volatility remains elevated and traps are common. After that, price can chop, lure participants back in, rebuild leverage, and then strike again when confidence returns. That's why the correct question right now is not whether the bull market is over. The correct question is who is trapped, how much leverage remains in the system, and what happens if volatility spikes again. That's where risk actually lives. Third takeaway, and this is critical for anyone emotionally attached to price targets. We are seeing classic bubble behavior, even if the long-term structural case for silver remains intact. Bubble behavior doesn't mean prices can't go higher. In fact, bubbles often overshoot targets dramatically. It means moves become emotional, reversals become sharp, and conviction gets punished. Silver can absolutely spike toward triple digits and still collapse fast enough to make people question whether the rally ever existed. Both outcomes can be true in the same cycle, and that's why disciplined players stop gambling and start measuring probabilities. The biggest mistake retail traders make is treating price targets like promises. Silver to 100 is not a contract. It's a scenario. It depends on liquidity, positioning, forced selling pressure, and the behavior of large players. When margin keeps rising and volatility keeps expanding, downside risk grows, even inside a bullish macro thesis. That's the certainty ladder. Facts first, probability second, narratives last. Now let's talk about why the 100 level even matters. Not because it sounds impressive, but because once major psychological shells like 50 and 80 are cleared, the percentage move to 100 is actually smaller than most people realize. The market doesn't need a miracle to get there. It needs continuation. But late cycle continuation is messy. It's a staircase with trapdoors, and every step higher invites more leverage, more emotion, and more vulnerability. So how do we know whether the next push, if it comes, is real? We watch two things relentlessly: behavior around key levels and behavior of participants. Key levels are where professionals act, measured move targets, extension zones, algorithmic profit-taking areas. When silver hits those zones, selling is expected, even in bullish environments. That selling isn't bearish, it's mechanical. But when mechanical selling collides with emotional buying, you get exactly the pattern we just witnessed: expansion, exhaustion, partial rebound. That sequence is the market's way of telling late money, welcome to the blender. Now here's the fourth takeaway, and this is where experience separates from noise.